Hey everybody, it's Chris Kirkpatrick with Life 180, and thanks so much for being here. I am excited to talk about today's video because if you know me, I just want to put this out ahead of time. Like when I first started this channel, I was coming off being the head of business development for a Fortune 1000 life insurance company. I have a background in life insurance. I love life insurance as a vehicle when used properly. Sadly, most of the time, life insurance is not used properly by most agents out there who don't know what they're doing. But I wanted to do a video right here because Dave Ramsey created a video on why infinite banking is a scam. And because of my passion in working with entrepreneurs and helping entrepreneurs build their businesses, create more cash flow, I'm a huge believer that your financial strategy as an entrepreneur is absolutely essential to the longevity and well-being and success of your business. I mean, too many businesses, especially right now with what's going on in the world, the uncertainty in the markets, the way that the markets are being manipulated with GameStop and all these things that are going on, it is 100% essential right now that everybody who is running a business, that you want to make sure that you have a system, a financial system. And it's not just about the products. It's not just about, what account you have your money in. It's like, what is your system? What is your objective? Like, how are you utilizing money as a tool to help accomplish the growth of your business? And I think too many people look from a too short-sighted a perspective. And I know it confuses a lot of people on my channel here that I talk about money so much. But the reason I talk about money is because I'm so passionate about it and because of the fact that, yes, I have this background and experience in it, but I just want to be fully transparent as before I get into this, that while you may see other videos from other people in on YouTube here about infinite banking, you may find videos from other people that want to rip Dave Ramsey apart for his opinion on this stuff. And believe me, they're out there. You're not going to find another video from somebody who's put this much effort into explaining this to you from somebody that really has nothing to gain. I cannot sell you anything. I literally can't. If you have a business that you want help building online, I can help you there. I cannot sell you a life insurance product. I do this because this is what I coach and consult people with. Even if I can't get paid, I would suggest that you build a system in which your money works. And a lot of times for entrepreneurs, using infinite banking works better than the alternative, putting money in a qualified account or something of that nature where you give up control of your money. And then when you need it most for your business, it's not there without penalty or taxes or something of that nature. And so without further ado, I'm going to get into this video, and I'm going to just start by playing the intro clip to this video where kind of the caller calls in and starts having a conversation with Dave.
Better than I deserve. How can I help?
Well, I had a question for you. I've been working with a financial advisor who's given me some advice, and I follow the show. I'm on baby step 7 currently. But he presented me with an idea that was a little outside the box. And I have term life insurance. I've been anti-whole life. But he presented me with this infinite banking concept.
Jesus, you're kidding me.
Money.
All right. So first and foremost here, like, I don't know about you, but I could just sense Dave's irritation. And the part about his irritation that kind of drives me crazy in this context is he didn't ask this guy any questions. He just is jumping at the like right out of the gate on the assumption that this is just a horrible idea. But Dave doesn't have any understanding about, is this guy a business owner? Is he not? What are his objectives? What does he need this money for? What is his risk tolerance? Like, what does the rest of his financial picture look like? What are his insurance needs? Like, and I know Dave Ramsey hates life and like whole life insurance no matter what. And he's the term insurance and all that stuff. But like, at the end of the day, like, he doesn't seem to care. That's the one part about me that can't stand the advice that Dave Ramsey gives is just very, very cookie cutter. And that may work if you want to remain middle class. And if you want to just like do something very basic and you're happy, making $40,000 a year and not doing anything significant and just scraping by to maybe hope that it works for you, in 40 years when you retire. But if you're an entrepreneur, if you're a real estate investor, if you want to do, heck, if you're a day trader and you're looking to do things and have access to capital and have a strategy where your money can grow and still have liquidity and tax benefits and all these things that go with it, following Dave Ramsey's advice, I think you intuitively know that his strategies are not going to work for you. So I just want to say that as we get going into this. So then after he does that, like, watch this clip.
So, because those are both mutual companies. Now, there are two types of life insurance companies, mutual and stock. Okay? Likely you bought your term, unless you bought it from him, from a stock company. A stock company, stockholders own the insurance company. A mutual company, which is Pru and Northwestern, State Farm is mutual, is the policy holders are actually the stockholders. Okay?
Okay. Yep.
So when the company makes a profit, the policy holders receive a dividend, as if they were a stockholder and received a dividend. Does that make sense?
Yep.
Now, follow the math here. If you are the owner of the company and you're also the customer of the company, and the only place the company gets money is from the customers that are owners, and they give you money from a profit, by definition, that means it's because they took too much from you as a customer. There wouldn't have been a profit otherwise.
All right, so Dave is actually pretty accurate on some of this stuff in the way he describes stock companies versus mutual companies. And yes, in stock companies, stockholders get paid, and in mutual companies, the policy holders are like the stockholders. And the problem is that it really is only a half truth. We're going to get into that in a second. But the thing that I found laughable about this statement is he actually says that Prudential, he lumps in the same group with Northwestern Mutual. Now, if he had lumped them in with like Mass Mutual and New York Life and Ohio National and, I could go on and on and on about the great mutual companies out there. That's like neither here nor there. Lafayette Life, like all these things. But he names Prudential. Prudential became a stock company back on December 15th of 2000. So it's been 2 decades since Prudential was not a stock company. So this, like, my gut on this tells me that Dave Ramsey is just massively out of touch. He's just been, this tells me that he's been saying this same thing, beating this same drum, not doing any research, not like, and I'm going to go into it even more because he just gives so much half truths in his statements. And the sad part is, if you have not done the education and like researched and like gone into the numbers for yourself and actually analyzed it, which I would encourage every single person to do, because you should never do anything you don't understand. But if you haven't done that, then it's easy to take what he says at face value and just kind of take it for granted and just dismiss it and like write whole life off as a scam. And believe me, I'm going to explain in a couple of minutes. There are a lot of whole life policies that, quite frankly, are scams. But it's just, anyway, it's something to take into consideration. And so he's going to get into talking about some more stuff here. So watch this next part.
So the IRS has deemed, consequently, that mutual life insurance company dividends are not dividends in the true sense of a dividend, that instead they are, and this is the IRS's language, they are instead a refund of a deliberate overcharge. So they overcharge you in order to give you some money later to make you feel like you're making money off of them. And it's absolute hogwash. It's a pass-through. Mathematically, it's a pass-through. It's the way it has to be. It's the legal definition of the freaking company, and the IRS says so.
So Dave talks about the dividend being a return of premium. So it's not actually a dividend. And once again, this is a half truth because yes, it is classified by the IRS as a return of premium. And so that's what it is. However, he's not talking about what the benefits are of that. And it is absolutely tax beneficial. And so insurance companies want it this way because of the benefits that it offers the whole life policyholders. So the people who are essentially the stockholders in the whole life company is the policyholders, right? And so here's the other thing. He's also talking about the fact that if they're doing that, they're just charging you premium, because of the return of premium concept. He's saying that the only reason they're classifying it as a return of premium is because they overcharge you to get there. And he's essentially kind of positioning whole life companies as a Ponzi scheme, saying, well, if all they're doing is taking your premium and then paying some back based in dividends, and they're only giving it to you in the form of a return of premium, well, by definition, that would be a Ponzi scheme. Like, if you break down what he's saying, that is the definition of what he's saying, because the only way to get enough new money in to pay any return of premium back after expenses would be because of the fact that, like, they have new money coming in and enough new money coming in to actually pay that dividend back. These companies have been around since the late 1840s, early 1850s. It's 170 years in a lot of situations. Like, it is not, there's no, these mutually held companies are the most stable financial institutions in the United States, more than any bank, more than anything. They've never had to be bailed out. They've never, I'm going to get into that in a couple minutes, but like, it's absolutely insane that he kind of makes this statement. And the other thing to think about is, like, you need to understand what happens with your money when it goes into a life insurance policy, into a whole life insurance policy with a mutually held company. Your money is taken by the insurance company and put inside of a general account. Now, I'm going to keep this simplified. You can get deeper on it if you want, but your money goes into a general account. They use that general account. Your money gets pooled with a bunch of other people's, with all the other policyholders. And the insurance company then takes that money and they invest it. Now, the great part is, because the insurance company has all these risk management teams, they utilize products. They utilize, so when I say products, I mean like annuities. They utilize term life insurance. Mind you, he's talking about how their term life, later he's talking about it being overpriced. Term policies are overpriced with mutually held companies, but the reality is they're not in all situations. And the other thing is, you don't get paid a dividend when you have a term life policy. Life insurance companies, mutually held companies, utilize term insurance as profit centers, right? That's what they do. Don't forget, 98% of the time, term life policies lapse. They're massive profit centers, more profitable for most life insurance companies than whole life insurance is. That's a fact. And so that's one thing that's he never talks about. So, but it's important to understand that when your money's in these general accounts, they utilize annuities, they utilize term life insurance, they buy corporate bonds, they buy treasuries, by the U.S. treasuries, they buy all sorts of other investments, and their goal is to create a return. Your dividend isn't just a return of premium. It's paid to you in the form of a return of premium for tax benefits, but the performance of the general account is ultimately what drives that dividend. And yes, they have the guaranteed dividend, but they also have the current expectation of dividend that they're paying, and that's all based on the performance of that general account. Now, the great part about that is the performance of that general account is really taken over a long period of time. One of the reasons dividends have been going down of late is because interest rates have been at all-time lows for so long. And if you look at it, a lot of these insurance companies had 30-year treasury bonds that were paying 20% on their books for 30 years. So that was really helping in a lot of ways. And so, dividend rates in insurance companies were over 12% at one point in time here, and now they're down, in the guarantees. The current rates are in the 6s, and guarantees are, around 4 typically, maybe just a little under 4, depending on the company. But like, what he's saying about it just being a return of premium and essentially positioning it as a Ponzi scheme is a flat out lie. So he's either massively uneducated and being 100% irresponsible about this, or he's being completely fraudulent. And there's no in between in this on me, because this man does this for a living. He gives advice out for a living. And what would the word be? The conflict of interest behind the advice that he's giving. Like, nobody talks about the fact that Dave Ramsey owns term life insurance companies. He owns a system that sells term life insurance leads. He has all this stuff that's going on, and he has this system of financial advisors that is a massive profit source for him. So while he's like out there preaching that all these life insurance agents are out there to just like take your money in whole life insurance, and his system of expecting 12% returns, in mutual funds is reasonable, is just absolutely flat out absurd to me. And honestly, like, I don't understand how this guy hasn't been sued at this point in time, because it's a travesty. So, all right. So check out this next clip.
So,
yeah. The thing I didn't love is, when you take the money back, you basically are paying an interest rate on it.
Exactly. And whose money is this?
Right.
That you're borrowing your own money and you're paying them interest?
Yep.
This is infinite banking for them.
Yeah.
Yeah, the infinite banking concept is old school, whole life, done poorly. You need a real financial advisor, not an insurance broker that's trying to sell you a load of manure.
All right, so he and Dan, this is a really fun one for me. So Dave is talking about the fact that infinite banking. This is infinite banking for the insurance company. Well, so because he's saying you're paying money to borrow your own money. Well, nothing could be further from the truth. In fact, it's important to understand that when you're utilizing the infinite banking concept, you are borrowing against your money. What does that mean? That means you're utilizing the capital that you have inside of your policy as collateral. Inside of the contract, the terms of the contract of your policy, the life insurance agrees to, on a guaranteed basis, utilize that policy as collateral, right? Now, it doesn't always make sense, by the way, to go through the insurance company. That's probably a different video. It's a different level of strategy based on if you're an entrepreneur or a real estate investor, if you want to utilize this. But it doesn't always make sense to utilize the whole life insurance company. Sometimes you can take the collateral that you have inside of your own banking policy and you can leverage that as collateral with a bank, with another lender, maybe a hard money lender, maybe something else, depending on what you're looking for, how you want to use it. I don't know why you do it with a hard money lender, because they're going to charge you so much. You might as well just take a loan against your own money and use the insurance company's money. But if you're a house flipper, that just is another reason that you would want to do this, because it's capital that you have access to. But you're utilizing as collateral. So let's just say you have $100,000 in your policy and you want to take a $95,000 loan against your policy. Notice I didn't say loan from your policy. You're not taking your own money. You're taking a $95,000 loan against your policy. You're using your $100,000, your $95,000 out of the $100,000 in your policy as collateral to take this $95,000 loan, right? And so what happens is you have this loan and you're paying, let's say you're paying 5%. Well, you're paying a declining, or just basically an amortized payment, meaning the interest that you pay is like a mortgage. It's higher at the beginning and it goes less and less and less and less and less until you pay it off. Well, guess what? That $100,000 that you had, let's say you're only earning 5%. So it's like a wash on the surface. That $100,000 is working for you at 100% capacity. It's earning 5%. So while you have a loan at $95,000 that's going down and down and down on the interest you're paying, you never interrupted the compounding in your own policy, in your account, in the cash value there. That's going up at 5% every year. And if you look inside of a policy and once you get past, well, let me say it this way. If you structure a policy properly, once you get past year 3 or 4, as long as your ratings and your age, and there are certain variables that come into it. So this isn't 100% across the board, but for most people, you should be able to set it up so year 3 or 4 into your policy, the amount of money, new money that you're putting into your policy, let's say you're doing $20,000 a year into your policy, your account value should be going up by more than the amount you're putting inside your policy. And then it ultimately should break even between years, 6 and 8 or something of that nature. But at the end of the day, the new money that you're putting in, it's the biggest no-brainer, because you're way ahead. And once again, if you're comparing a whole life insurance policy to a mutual fund, then yeah, it's going to look bad for the first couple of years. But if you look at it over the long run, if you actually break down the fees, the managed money fees inside of a managed money account, and you're paying 1.5%, maybe 2% on after you include all your managed money fees, your broker fees, the mutual fund fees, all the things that go with it, over a 30, 40-year period, the fees inside of your whole life policy are actually going to be very comparable to the fees that you pay inside of your mutual fund policy. So yes, there's a little bit of a short-term liquidity issue. Maybe you're going to have to give up 5% liquidity compared to what you would have, or as far as you're going to be a little negative for the first couple of years. But the bottom line is you're in a situation with infinite banking that you have liquidity of that money, so you can utilize it. You don't give up control of it. You don't have to wait until you're 59 and a half to gain it. So you could take that money and you can get real estate with it. It's security. It's a backup plan for your business. You can reinvest it in your business. And in fact, I would say if you can't take that system and that strategy and invest it in your business to increase the profit, the cash flow, the well-being of your business by 8 to 10% per year, I would say you're probably in the wrong business, right? So that's something to really consider. And the other thing that drives me nuts about what Dave says here is the fact that he's like, oh yeah, well, it's the infinite banking for the insurance company. Well, guess what? Banking is a scam. He wants to get after life insurance companies as a scam. What you do when you do the infinite banking concept is you set yourself up as the banker. Life insurance companies, you're not going to find a more conservative financial institution in the world than a life insurance company. Think about what you do with your money. If you have your money in a bank right now, a credit union or a bank, you're going out there, you're putting your money in a bank. Maybe you're earning 0.1%. Maybe if you got a lot of money, like 100 grand, they'll give you a high interest savings account. Maybe they'll pay you 1.5 to 2% or something of that nature. But think about this. If they do that, even like you're putting your money in 100 grand, what do they do with that money? They leverage your money 100 to 1 because of the fractional reserve banking system that we all live inside of, right? They leverage your money. They create massive amounts of profits. And what do you see? 0.1% to 2% at the best, right? Like, to me, that's infinite banking. That's the scam. And that's the system that when you follow Dave Ramsey's advice, that you're taking part in. And I don't know about you, but if you're somebody who is value creation mindseted, if you're an entrepreneur, if you're looking to create something, and yes, the infinite banking is not for everybody. If you're just planning on taking your money, putting it into a whole life policy and letting it sit there and not doing anything with it, well, then just close this video down and stop thinking about it, because it's probably not for you. But if you're an entrepreneur and you're an investor and you want to do something significant and have liquidity, you understand the importance of having a financial system to create leverage, that's what this is about. The problem is, like, Dave Ramsey just doesn't understand that. And so I don't know about you, when life insurance companies do this, when they operate in the system, when they pay back through return of premiums, and when they take the profits that they have from the profits from their investments in corporate bonds, in bonds, and other investments in the world, when they take profits from their own products like term life insurance and annuities, they take all that and they pass it through the general account and they pass it back to the policyholder. So you're investing in some of the most stable financial institutions that have ever existed. And so tell me how that's bad. I don't know about you, but for me, that's exactly where I want to be. Like, if I'm going to be running a business and growing a business and building a real estate empire or anything of that nature, I don't want my money in the market where I'm putting it somewhere where I have no control. I have no access. I don't have any control of the results. I have no liquidity. I'd rather have my money in a place, not with a bank where I'm letting them leverage my money to create wealth for them. I'd rather put my money in a system that I have access to, that I can take part in. And yeah, it's not super sexy, but it's 100%, like, it 100% works, like 100% of the time, if you do it right and you actually utilize it right. That's a fact.
And so, yeah, the other thing is that your cash values that are sitting there all die with you. So whatever cash you put into this is equals zero at your death, because they only pay the face value. Pru does not have a policy. Northwestern Mutual does not have a policy that pays more than the face value, except Universal Life Bs, which are not in infinite banking products. And Universal Product B is where they charge more than they usually charge, which basically buys the insurance so they can still keep your money, is the way the math actually works on this. So you're dealing with one of the most expensive insurance products in the marketplace. If you're dealing with either one of those two companies, I would stay completely away from both of them. They're everyone in the financial field except people that work for them, we all think they're a joke. All of us. Anyone who's academically trained or has any kind of CFP or anything else, when someone says they work for Northwestern Mutual, we just kind of laugh and go, yeah, right, you screw people every day. Yeah, so, dude, you need to get away from them, and you need to go get a real financial advisor that can help you do some real investing that takes into consideration your low risk tolerance. Low risk tolerance does not need to lead you to losing your money, 100% of the cash invested at death.
Yeah.
That's a bad risk tolerance thing. So you need to move on, dude. You need to move on.
All right, so this is probably the comment that I get the most on my videos, is that the reason whole life insurance is a scam is because the life insurance companies steal your cash value when you die. Well, guess what? This is actually, I hate to say it, Dave Ramsey is right to a certain extent. He's right. Once again, it's kind of like the prudential comment earlier. It's like, it's way outdated. That is how it used to be when life insurance companies kind of started. They have changed. I would never advise anybody to buy a policy like that, first of all. So if you're making that argument and that's your fight, if that's the hill you want to die on with this and plant your flag and your argument against this, Dave, well, then that's just a false argument. And once again, you're just spreading lies, because there's nothing could be further from the truth in this. When you structure a policy, let's say I get a $1 million policy. Let's say it's completely optimized for cash value. And I take that $1 million policy and I have it 100% optimized for the IBC and what we're doing. And that policy grows, like the cash value inside that policy grows. By the time the policy gets to $500,000 in cash value, my death benefit is going to be 1.5 million or something in that range, right? So yes, do they keep the cash value when you die? Sure, you could say that, but the bottom line is the death benefit isn't the million, it's 1.5 million. So they keep the cash value, but they give you the extra cash value in the form of death benefit. Why do they do that? Because if they pass it on, when you inherit money, if you have money that you inherit from a relative or anybody that just, gives you money, the inheritance from an estate, and that money's in a bank account, you are taxed on that money. So it would be the same way in a life insurance contract. The reason life insurance companies keep that $500,000 in this example is because they just flip it to life insurance if you structure the life insurance properly. Because what happens is instead of the $1 million, being, or like out of the million, it would be $1 million of death benefit. And they'd say, okay, well, we're going to give you $1 million and 500,000 if it's taxable. No, they say like, we're going to give you 1.5 million and we're going to just keep the 500,000. So what do you do there? You get the $1 million of death benefit that you paid for, and the extra $500,000 of cash that they took from you, according to Dave, is actually what's happening with that. That's getting lopped on top of the death benefit, and you're getting paid it's getting passed through the life insurance policy, giving you all the tax benefits, which ultimately is going to save you estate taxes because you don't have to pay estate taxes on this life insurance. So like, think about that. Like, he's taking and giving so much misinformation about this and is hurting people. It is absolutely mind-boggling and astonishing to me that he's able to do this and that nobody calls him out on it and that people buy this garbage.
Man, I tell you what, pisses me off. Infinite banking my butt.
Okay, Dave.
Infinite banking is for them.
Yes.
The only thing that agent has for his whole life is a need for your commission to be paid to him.
Absolutely.
That's the only whole life thing that is involved here. These products are horrendous.
Yeah.
And it's bad enough when they feed on the middle class, but that guy's a baby step 7, man. He's probably a millionaire.
Yeah.
And they create such a jumbled word picture that you can't cut through the BS.
All right, so I'm just gonna end with this. Like, I mean, you could tell. Like, Dave is just he's just got this arrogant tone to him, and like, I guess I'm kind of worked up right now too. But like, it's just, to me, his advice. What I started with, he gives this bogus advice. He doesn't. It's all half thought out. It's half truths. It's self-serving for him because of his business interests. The fact that nobody sees that is absolutely insane to me. That people don't look through to that and like put 2 and 2 together. He talks to this gentleman who calls up, doesn't ask anything about his objectives or whatever, gets right to the product, is very product focused and whatever. And that's the biggest problem. Like, that's one of the reasons, like, all the people that I coach, entrepreneurs that I coach in building their business, and like I said, I can't help them with their finances. I can't sell them any products or services. I have people that I would suggest that you work with, people that I work with myself personally at Better Wealth. And I would totally have you reach out to them and connect with them if you have any questions about this. I'm a big believer nobody should do anything they don't understand. Dave Ramsey is the exact definition of what I think is wrong in the financial industry as a whole. One of the reasons I left the financial industry is because it drove me crazy. And it's very product focused. It's very, you work for a company and you have to sell a product. You have to do this, you have to do that. Like, it's about like hitting metrics. It's about qualifying for President's Club. It's about making sure that you have an alliance or allegiance with one company or 2 companies, and you try to, hit leaderboards and do all these different things. So make no doubt about it. I don't care if your person works for, Smith Barney or Morgan Stanley, or if they work for, it's one of the other companies out there. It doesn't matter. They're all just, or Northwestern Mutual or New York Life or any of those companies. Some of the companies are good. Some of them have good products, but not all companies do all things for all people. And I think the biggest problem is we got to stop thinking about products solving our financial issues. There's a massive disconnect in financial education in this world. And as an entrepreneur, you need to understand your finances, both your personal finances and your business finances, and the system in which you can run your business through financially to create stability, security, opportunities, and control, because that's going to be leverage when you need it most, when there is opportunity. That's what I created my Life 180 pyramid video, is to explain the importance of that. And I'll link that above here. And so that's a really important distinction to understand there. So what I would say to you is really make sure whatever you choose, understand it, but don't just think a product is going to solve your problem. You have to have a system, and you have to make sure that you work it, and you have to be focused on creating value. And that's one of the reasons I work with Better Wealth, is because that's their philosophy. And I've been working with them for years now. And I got to tell you, you owe it to yourself to check it out. And like, I don't want this to end up being a sales pitch for them, but like the industry is broken. And this video from Dave Ramsey, and pretty much all his content, quite frankly, in my opinion, is an example of what a joke the financial industry is, and just how dangerous the advice is in pushing different people in different directions into different products and mutual funds and ETFs and stocks and bonds and, you know, even life insurance, thinking it's going to solve your problem. And to that point, I will say the part that I agree with Dave is most life insurance are idiots. Most life insurance agents are idiots. They don't know what they're doing. They structure policies improperly. I have a guy that I started coaching a couple of weeks ago, and, you know, he's like, hey, I have a policy with a company, and this company, you know, the policy, and I was like, well, I'll take a look at it, you know, and he's like, I'm putting, you know, $11,000 a year into it, and so I took a look at it, and we looked at the cash value, and I'm like, and it was a 3-year-old policy, and it was a disaster, right? Like, but he wanted to buy it for kind of what I'm talking about with the infinite banking strategy, right? Like, but it was designed totally improperly, and the agent who sold it made massive commission compared to what he should have if he did it right. And so, like, to that end, Dave Ramsey is right. There are a lot of unscrupulous people out there. But to say that about life insurance agents and to not acknowledge that that's the case with financial advisors as well is just, it's just fraud to me. Like, it exists. People are people. You have, like, there's going to be good people and bad people in every industry that exists. I don't care if it's the financial industry, like stocks, bonds, mutual funds, all that stuff, or the life insurance industry, or if you're just going to buy a widget down at a store. Like, you're going to have good people, bad people. Some people are going to try to take advantage of you. That's why you have to take it on you to be as educated about what you do as possible, especially if you're somebody who's building a business, who's investing in real estate, who's trying to create value in the world. It is 100% on you. And outside of mastering your craft or whatever it is you're doing, understanding and having a financial system that fits what you're that fits a way that would try to enhance what you're doing, nothing is more important than that. So anyway, I hope that helps. I hope that inspires you to take action and at least think twice about what's going on in your world. And if you have questions about anything, feel free to reach out. I'll put a link down below for Better Wealth if you want to talk to them. There will be a bit.ly link down below that you could check out. And if you want to talk to me, if you have any questions about building your business or creating more cash flow or anything, that's kind of my focus, coaching entrepreneurs in all these areas. Feel free to reach out anytime. You can go to life180.com and check out. I have a scheduling tool at the bottom of my page. Feel free. My calendar's open. Get on it. It fills up fast, and look forward to talking to you soon. Until next time, have a blessed, inspirational day. We'll talk to you then.